There is a tremendous need for infrastructure, and you're right, governments have a hard time making the commitments and funding these improvements. That's where public infrastructure companies, private infrastructure investment firms can actually step in with the capital and provide the expertise, the capital to build and operate new infrastructure projects. In fact, capital-constrained governments are a principal reason why infrastructure investors have opportunities. And these opportunities are great and can drive performance of the infrastructure stocks. Considering inflation and interest rates, inflation is a tailwind for performance of equities because these companies can raise their prices, raise their dividends as inflation increases. On the other hand, rising interest rates is a tailwind for performance. It reduces the present value of your future cash flows. So what we are looking at is which will dominate, the positive impact of inflation or the negative impact of rising interest rates. Our belief is that inflation is actually going to be a little bit stronger than rising rates. And so what we will continue to get is positive performance from both real estate equities and infrastructure equities. So real assets, publicly traded infrastructure equities, real estate equities, MLP equities, mortgage bonds, both residential and commercial, and debt in the real asset spaces of real estate, infrastructure, and natural resources. These assets tend to behave differently than many other parts of the market. In particular, if you were to look at the correlation of each of these assets to each other, the correlations are generally between 0.5 and 0.75. If you look at the correlation of these real assets to the broader equity market and the broader fixed income market, I want to highlight the diversification benefits of residential and commercial mortgage-backed securities. They have among the lowest correlations to global equities and very low correlations to global bonds. So it can be a terrific diversifier for your portfolio. All of these asset classes pay coupons. With the mortgage portfolio, you typically have a lot of floating rate loans. So as interest rates rise, the coupon rises and the value is preserved. But with the equities, you have the ability of these companies to grow their dividends, raise their payouts as the economy accelerates and inflation moves.